Thanks everybody for joining today. Today's webinar is about Monte Carlo analysis for retirement planning. I'm going to go through why Monte Carlo is so important for retirement planning and how Monte Carlo guardrails can make your results more realistic. My name is Doug Carey. I'm a chartered financial analyst and I'm the founder of WealthTrace.
I'm Dan Rooker. I'm a new joinee to WealthTrace. I'm a financial planner and really excited to dive in with everybody today on Monte Carlo and guardrails with our founder, Doug. So thank you for being here. And without further ado, we'll kick it off.
Thanks, Dan. All right, so the agenda today. Well, we're going to start out by explaining what Monte Carlo is and what it tells us in terms of financial planning and retirement planning. I will discuss how Monte Carlo works in the WealthTrace software. I will explain what guardrails are and why they can be so important when running Monte Carlo analysis. I'll talk about sequence of returns risk. I want to go through this because it gets talked about a lot more these days, and I want to show how this risk can be reduced by using Monte Carlo guardrails. And then we'll dive into the software. I will show you how to model guardrails in WealthTrace and how to run quick what-if scenarios. Also, I wanted to mention that our Director of Client Services, Camille, will be answering Q&A as we go. So look for the Q&A box at the bottom of the Zoom screen, and you can ask questions as we go. She will answer as many as she can, and then she'll leave a few of the more interesting ones to the end for me to answer.
I'll
All
also
right.
add that there's going to be a chat as well. Camille is going to add, hopefully, links to things that we prepared today. You can also message host us in the chat as well if you have specific questions or technical issues.
So, what is Monte Carlo? I like to use the example of weather forecasting because we can all understand, a probability of it raining tomorrow. So, let's say the probability of it raining tomorrow is 40%. How did they get that number? Well, they use Monte Carlo simulations. What they do is they plug in thousands of variables, such as the time of year, wind speed, air pressure, latitude, all sorts of variables into a complex model. They run thousands of simulations to see if it rains. They count up how many times it rains in the simulations and divide it by the number of simulations run. So let's say they ran 10,000 simulations, and in 4,000 of those, it rained. Well, your probability of rain tomorrow is 40%. Now, we use this idea in financial and retirement planning too. We run simulations, and Monte Carlo works by running different paths with different rates of return on your investments. And we use historical data to move those returns around every year in every path. And we count up how many times you run out of money, and that gives us the probability of not running out of money, which is your Monte Carlo result. Now, in Wealth Trace, what we do is we run 1,000 simulations. Again, we base this on your historical performance of your holdings. We actually look at the holdings that you own, whether you manually entered them or linked to your accounts. We will drill down into these holdings to give us a more accurate Monte Carlo result.
Doug, how does that work in a market simulation within the software in general, drilling down into every holding?
So we have information because of the way that we have linking and third parties providing us historical data on uh, the type of investments you own for every holding, the asset class, and then the historical returns, the historical volatility, and the historical correlation with your other investments. So this is extremely valuable information, and we look at the holdings level, which gives us the most accurate Monte Carlo result basically you can get because we drill down into the finest level of detail possible. Uh, Also, in terms of holdings, just as a side note, because we have so much information on them, you can look at other screens in the software for your performance history for your holdings. You can look at your transaction information, such as deposits, withdrawals for your accounts, dividend payments, interest payments, things like that. So the holdings information is extremely valuable and is pretty unique to WealthTrace. Okay, so let's talk a little bit about Monte Carlo guardrails. What are they? What do they do? These are spending thresholds. So standard Monte Carlo models usually ignore how people can change their spending behavior when the markets change. So let's say the markets are having a really bad year. A lot of people will decrease their spending in that year. So guardrails will allow you to adjust your spending in down years and up years. So if your portfolio is way down, you can say, well, I would cut spending by X% in that year. If the market's way up and your portfolio goes way up, you can tell the program you'll increase spending in that year. So these can be thought of as a shock absorber. I really like that description too, because that is what it does. It absorbs the shocks of the markets moving around a lot, and in most cases will improve your Monte Carlo result. On a similar note, guardrails help with sequence of returns risk. Sequence of returns risk is the danger of the market going down a lot early in retirement if and when you are spending down principal. So if you're withdrawing money while the markets are going down, this is sequence of returns risk because the early losses compound, leaving too little money left to recover when the markets rebound. So guardrails can help with this by reducing the amount you withdraw during this time. So as I mentioned, guardrails can protect against early poor retirement returns because your portfolio is in a sense being monitored. You can replace a standard fixed withdrawal idea with adaptive spending based on what your portfolio is doing. So you can reduce your spending after the market declines. That limits withdrawals when your investment assets are under stress. It also allows you to preserve principal for the inevitable market recovery, and then you get that compounding of your principal later on. So it makes your plan more durable across the Monte Carlo scenarios. Now, this is very interesting. I found this when I was running a bunch of different plans. I was really putting it through the ringer. Your fund expenses, or sorry, how you fund your expenses matters when it comes to how big of an impact guardrails will have. Those who pay for most of their expenses or all their expenses out of retirement income, they're not as susceptible to sequence of returns risk, so guardrails won't have as big of an impact. But those who will be withdrawing from their investment assets to pay for expenses, that's when guardrails will help the most. And we'll see that when we get into the software.
Mhm. And Doug, you've got this incredibly complex analysis tool that you're calling standard Monte Carlo. I think you've elevated it a bit. As a practitioner, I see what the advisor tools provide, and I'd say our standard version of Monte Carlo is more elevated. But guardrails is an enhancement to it, really. And guardrails is something that I haven't seen, I still don't see with advisor tools. So I think that it's just really exciting to be able to manipulate and enhance at the granular level of my own plan by using guardrails. So no question really there in these statements. Just thinking that the tool itself, the feature is just pretty incredible. But yeah, I'm interested to see what it looks like.
Yeah, let's dive into it. Let's go ahead. I'm going to share the actual app. And just to expand on what Dan was saying, I too believe it's more realistic. I use it for my own plan, and I love it. I love playing around with it, and you'll see why here in a minute. So here we have a demo plan I just put together. We have a couple. They're 51 years old. They will retire when they're 58. They both work and are making $150,000 each. This is in the plan settings, personal information section, by the way. I set up some simple investments for them. They have, this is cash flow inputs, investment accounts. Uh, this is, they have a taxable brokerage account worth $750,000. They also each have an IRA worth $500,000 each. Their asset allocation, you can see up here, they're 60% in stocks, 40% in bonds. So fairly standard, simple plan. They will have a combined Social Security of $70,000 when they turn 67 years old. Their recurring living expenses once they retire will be $95,000 a year. And they are going to purchase a second home when John retires for $300,000. Now you can see up here some static results. They're projected at the retirement to have about $1.8 million, and at the end of their life expectancy, 1.4 million. Now, this is what we call the static projections, and that means that their returns on their investments are the same every year. Okay, they're not changing. Now, that is different than what Monte Carlo does, because in Monte Carlo, of course, we are going to move their returns in every year in every simulation. And that's what makes Monte Carlo so powerful. It's more realistic because we have markets moving around. And on that note, let's look at their Monte Carlo result. If we just clicked on the Monte Carlo option on the menu, it will immediately run 1,000 scenarios on their plan. So let me start by turning the guardrails off and run this. So I reran it by just clicking run simulation here. So with no guardrails, their probability of never running out of money, what we call the success rate, is 78%. So in the scenarios they do run out of money 22% of the time. You can get a little more information if you scroll down. You can see all the 1,000 paths here. The median path is in the middle. The 75th percentile, which is if you rank these paths in terms of the end result from 0 to 1,000, where 0 is the worst, 1,000 is the best. This is path number 750. The red one's path number 250. Now this is again without guardrails on. You can see they do run out of money uh, too often, in my opinion. 22% of the time, that's too much. But there's no adaptive spending here, right? When the markets are way down, maybe they'll cut their spending. In fact, I have it set to when their portfolio goes below $1 million, they will decrease their spending by 10%. If their portfolio goes above $2 million, they will increase their spending by 10%. Now, you might be wondering, where did I get those numbers? There's no science to it, really. I just looked at the ending value of their investments at the end of their plan, end of their life expectancy, on the median path. It was close to $1 million, so I said, all right, if it goes below that, they're going to cut spending. Then I looked at the value at the end of their life expectancy in the 75th percentile and said, all right, if it goes above that, they'll increase spending. Now, that's just a starting point. I believe if you're going to use this, you should play around with it. Come up with a realistic, come up with realistic thresholds that you really can stick to, and see which ones do anything to your plan, right? See which ones work and that you actually feel comfortable with. So let's run it. Let's see how much their Monte Carlo result changes. It went up to 91%, all because we put in a guardrail basically that says if their portfolio goes below $1 million, they'll decrease spending by 10%. That's a big jump, 13 percentage points. Now, what's interesting is in the median path, notice it says 0% of the simulated years they decrease their spending. They never decreased their spending on the median path. Great. All went fine. But in this path, the 25th percentile, look at how many times they decrease their spending. Every arrow is a year where they cut their spending by 10%. 68% of the time along this path. So if this is the reality that occurs, well, they'll be cutting their spending a lot of the time. All right, so that's what that means. You can see the dotted red line here is the lower threshold, the $1 million. The dotted green line is the upper threshold of 2 million, right? So it makes sense that when they cross the lower, you can see them cutting their spending. Now let's look at something that's a rosier scenario, the 75th percentile path. This is nicer. When they go above this threshold, they get to increase their spending. In fact, they do it about half the time if this is the path that actually occurs in reality. So we don't know which path will occur, but we need to look at, right, all the different possibilities. Now, this data is also available in table form, which I kind of like to use because you can see in the 25th percentile path, you can see their portfolio value, you can see their spending decrease here. Here's the median path. Here's the 75th percentile path. You can see them increasing their spending when the portfolio goes above $2 million. Now, I mentioned it a little earlier that it matters how much of the spending is being funded by income. This plan has a lot of their spending funded by withdrawing from investments. I want to change that assumption. Let's go back to cash flow inputs. I'm going to go to cash inflows and I'm going to add a pension. I'm going to add a pension for John of $70,000 a year. And I'm going to decrease the amount they have in their taxable account to $50,000. So their static projections are very similar, but their Monte Carlo might change. So let's turn off the guardrails again and rerun it. So no guardrails. Their Monte Carlo result is 80%. Okay, that's the percent of the time they never run out of money. That's without guardrails. Let's turn the guardrails back on again, and let's look at how much this changes. It only went up by 4%. That's in contrast to the last run where it went up by 13 percentage points. This goes back to what I was saying. The more you fund your expenses with income, the less impact guardrails will have, generally speaking. If you're funding a lot from withdrawals of principal, guardrails will matter more. And that's just basically saying sequence of returns risk all over again. So same idea.
It is, right? Like it's kind of like Doug, like you're saying the need from the portfolio is less. If we have guaranteed income, pension, social security, other source of income and inheritance, if something increases the value of the portfolio or reduces the need from the portfolio, sequence of returns risk is impacted at, you know, a lesser amount in the simulation.
Well, the risk is lower because you have that principal will be there or more of it when the
Hmm.
market rebounds. Really, that's the intuition. When the market finally comes back, you did not spend a lot more principal and it can catch the rebound. I think that's really the bottom line.
Yeah, for sure. Do you think we've gotten a lot of really good technical live questions
Hmm.
that have come in? Do you think we could take a break, just take a look and answer a couple of these? I can call one out if that's helpful.
Yes, please.
Okay, so one that I think will help with Monte Carlo is from Carl. Carl said, "Can you comment on what are generally accepted wise percentage of success numbers to target?" Let's start there and we can drill down into more difficult ones.
Um, yeah, I get this question a lot. It really does depend upon the plan. I would never give a number unless I say 100%, because it
Hmm.
depends. It depends on um, what your plan B is if things go awry. Plan B can be guardrails. This helps. Uh, Another plan B can be, do you have a lot of equity in your home that you can tap if necessary? Because the Monte Carlo does not take that into account unless you explicitly have said you're going to sell that home or tap equity later. So I can't give a single number. I will tell you that, I believe that generally speaking, being below 80% is dangerous. But other than
Hmm.
that, it's plan by plan.
It's plan by plan, and it depends. It's not a cop out, not even close. I mean, you could say you're 65, 25 years left to live, and the generally accepted principle of that withdrawal rate that we can Google 4%, 3.3%, whatever it is just a guideline. So same thing with Monte Carlo. There's an accepted range, but that range
Mhm.
really depends on longevity. Do you have a plan B? A ton of factors. But yeah, I'm with you, Doug. Less than 80%, that's too close to a coin toss for me. 100%, maybe that's leaving too much life on the table, maybe not.
You also reminded me to mention the scenarios here, which is a relatively new feature. You can quickly run scenarios in the Monte Carlo screen. So, for example, you mentioned longevity. Well, what if they live longer than expected? What if returns are lower? You can even change the returns here. What if their expenses are higher? For example, watch
100%.
this.
Yeah.
What if they end up purchasing a second home that's above $600,000? Watch the Monte Carlo result change.
And
Oh,
what Doug's doing is showing
that's
the sensitivity of the plan. So changing these levers is playing around with your specific plan's sensitivity. That's what matters. So it's not so much the number that you're aiming for, the target. It's if I get at 85% and I change my life expectancy by 3 years and it goes to 84, that's great. Or it goes to 86, that's great. But if it goes to 60, that's not great. Your plan's really sensitive.
Yeah, exactly. This can measure the sensitivity of your plan to certain variables. It can give you more comfort, just like guardrails can give you more comfort that you're fine if your expenses go up by, $5,000, $10,000 a year. I love running these scenarios again for my own plan. I'm always playing around with it just to give myself a sense of what my plan can take, how much, can these things change, and I'm still okay.
So I've got one more and then so one question that was asked early on was what rate of returns are typically used to model sequence of returns risk? I have seen anywhere from negative 15% to negative 25%, 3 years in a row. What is a more realistic, probabilistic number? I have my own answer for that, but the question was what rate of returns are typically used to model sequence of returns risk?
Well, that's that's if you're doing it the brute force method, you're forcing returns in there. This Monte Carlo has sequence of returns risk built in because at least one, probably more of these paths, well, you can see it here. Look at these paths down here. This is things going poorly right when they retire. That's sequence of returns
Hmm.
risk. So it's fleshed out in Monte Carlo in theory, right? Now you can force the issue. The way you can force the issue in WealthTrace is to run a bear market scenario if you wanted to, where you can say, we're going to have a bear market. And I can just go there real quickly. We're going to have a bear market right when I retire. So you can go here and you can specify the year is going to be whatever. If you're going to retire in 10 years, you can say 10 years, and you can run a bear market scenario and see just how painful that would be if that bear market occurred right when you retire. So that's a way to force the issue in Wealth Trace. But Monte Carlo, just so you know, does have paths that have major downturns right when you retire.
Hmm. Yeah, and I'd say that, the question, what is a more realistic probabilistic number? It is realistic that you could have Monte Carlo is probabilistic, and in a probable return, you could have a few years of really negative years and a few years of really positive years. I think people remember the negative years when they live through it, but then they hang their hats on the positive years. Last year was a super positive year, uh, plus 25% in the U.S. market, and that is not the long-term historical average, not even close. It was a great year. So is it realistic to have a really bad year? Yes, it would happen in order to make that 100-year average high single digits. It would have to happen.
Right, exactly. Um, Now there are several questions that I would like to get to with Q&A. Really, this is the end of the portion in the software. Uh, let me actually let me sit here for a minute just in case I need to show something in the software. So someone has a question about well, let's stick with the returns idea. When identifying return assumptions, how do you balance historical returns with future expected returns? So a lot of people think the market's overvalued right now, and how does that impact future returns? I don't like to take a stance on it. I like to use historical. We let the users take a stance on it, and here's how you do it. You go to your global settings and your asset class mapping. And these are the returns. You can change them right here. These are the defaults. And you can go in here, change them to whatever you want, and it will populate throughout your holdings in the software. So if you want to take a stance that returns will be lower going forward, this is one way to do it. Or you can just run scenarios in the software where you decrease the returns. You can do it right in Monte Carlo, as I was showing before. There's a little return section here. So you can say, well, in retirement, I think I'm actually going to get, about a percentage point less. And for both taxable and qualified, I'm going to rerun it. That's a quick way to do it. So that didn't hurt me very much. All right, someone asks, are bond and dividend income included in the income line item in cash flows and factored into the guardrails? Yes and yes. We show all of your income uh, year by year, both dividend and interest. And yeah, it is absolutely included in the Monte Carlo analysis because it matters. As I remember, I showed by increasing their pension, it changed how big an impact guardrails have. So Monte Carlo is taking into account a lot of different moving parts at one time. Oh, here's a good question. Sorry, I might not have made this clear. What dollar value are they cutting spending from? This is their living expenses. This is the living expenses I showed earlier right here. This number, 95,000. That's the number it's cutting. The annual recurring living expenses. Thank you for bringing that up. Just looking at some more questions. Oh, someone's asking about Laplace versus normal distribution. Let me show you that in global settings. Monte Carlo, you have this option, normal distribution or Laplace. Laplace has fatter tails on the distribution, so the bell curve, those tails will be fatter, which means more extreme events are more likely compared to a normal distribution. So if you are of the belief that we are more likely to have extreme events compared to the last 50 years of history, you might want to use Laplace or just try it out, click it, save it, and then rerun your Monte Carlo. Generally speaking, it makes your result worse. Extreme events are not good in Monte Carlo, generally
Hmm.
speaking. Um, there are plenty of people who believe that this is the proper distribution to use for stocks, at least, and normal distributions shouldn't be used anymore. I like to run both and see what both do, and I kind of, for my own plan, I'll just sort of take the average of the two.
And if you find a competitor that's using that gives you the flexibility to go between normal and Laplace, please email support at mywealthtrace.com because when I saw Doug mention that the first time, and I've been using some of the top advisor tools for the past 15 years, I don't have that option. So if you find
Yeah.
someone, let us know.
Yeah, I think that's the engineer side of me. I wanted to I wanted to be able to look at all the possibilities.
Right.
Another good question from a mathematical perspective. What is the difference in Monte Carlo results if you use 10,000 versus 1,000 scenarios? Well, long ago, I actually tested this. I tested a lot of different um, number of simulations, and it turns out that in my tests, 1,000 is really good. As you start using more than 1,000 simulations, the added benefit is very small. The benefit going from 500 to 1,000 is actually very large, but 1,000 is good. It's a good number. It balances speed versus accuracy, and yeah, I really ran that one through the ringer many years ago. Right, still looking at questions here. Hmm. So there's a good potential feature request. The rate of success number means your plan failed, or can mean you only failed by $1 in year 30 of retirement. So barely failed, right? Can you adjust this? Well, sort of. Guardrails sort of adjust that because you can say if my portfolio goes below a certain threshold, then you'll cut your spending. That would get rid of that little tiny failure that's not really a failure, right? Losing out by $1 in the last year of your plan isn't that's not really going to mean much. So guardrails kind of adjust for that, right? It would get rid of that particular year of failure. I think someone's asking about default values for all the things we're seeing here for these scenarios, and are they updated regularly? Default settings. A lot of them are, yes. Returns we update, inflation we update. Uh, Now we won't change any of these major assumptions without giving you the option to say no. So you'll see sometimes when you log in beginning of the year, we want to change the annual return assumptions. Do you want to do that? You can say no. So things like that. So yes, we do keep track, obviously, of a lot of movements in these different settings.
And I'm not sure that we touched on it so much in the presentation, or maybe a lot of times these presentations are packed and it gets missed. But could you talk, Doug, about uh, how we end up using long-term capital market assumptions in the tool? Like when someone links their account, their holding is mapped to an asset class, and that asset
Yes.
class has an accepted historical long-term capital market assumption. And that's something that the act of doing that is not across the board a standard. And how we do that is pretty robust.
Yeah, a lot of applications just force you to enter your own assumed rate of return, um, which and then it's just applied on an average basis for the whole portfolio. So yeah, we'll look at your at the holdings level, every holding, and we'll map it to one of these asset classes. By the way, you can create your own asset classes too, and map your holdings to those. but we will map to asset classes, which then have a historical rate of return, as you see here. These are my own, I changed these, but it will map at the holding level. And then when we're running Monte Carlo, we look at every holding's annual return. But more than that, we look at the historical volatility, what we call standard deviation, as well as correlations amongst the different asset classes. So that's how we do it. It's a lot going on behind the scenes, but it makes it all much more accurate.
It really does. And if you're not, if you don't like or you think you made a mistake about an assumption for the return for one of these asset classes, you can reset it to the default. And the defaults are
Yes.
updated. They're updated uh, every year. So
Hmm.
you're not, and it's not just we're not making this stuff up. It's it's grabbed from accepted academic information.
Yes. Yep. Absolutely. Oh, someone's asking about Monte Carlo, how to map it, like gold, silver, commodities. Uh, that I think the user needs to do a little bit of research, generally speaking, to look at the volatility. So, for example, gold. What's the standard deviation of gold over the last 30, 40 years? If it's 20%, then, well, it probably maps to something like growth stocks or even emerging market stocks, right? You can see the volatility here. So, given whatever asset class you're creating, you'll probably have to do a little work on your own end to calculate or ask ChatGPT or something like that what the volatility, the standard deviation has been for the last 30, 40, 50 years. Someone's asking if our scenarios are the same that other institutions use, like Fisher or Fidelity, when they calculate Monte Carlo. Ours, well, we kind of hit on it. Ours is probably much more accurate because of the way we drill into holdings. You can bet that they do not do that. I'm not saying they don't, but I would bet they don't. And so our scenarios will be different. They will be more, I believe they'll probably be more accurate. Now, the distribution, if it's normal, this is fairly standard math, so that part would be very similar for sure if you're using the normal distribution. Let's see. If you're living off interest and dividends versus realized gains, does that make sequence of returns risk less important? Yeah, definitely. If you have interest and dividends, that's income, right? Doesn't have to be a pension. That absolutely helps with sequence of returns risk because you're not dipping into principal as much as someone who doesn't have a lot of interest in dividends. So it's really cool because in the software, you can play around with changing your allocation to more dividend-based stocks versus growth stocks and run Monte Carlo and see how it impacts it. And it will take into account the fact that dividends, larger dividend payments will decrease sequence of returns risk. Okay, I think I got to all the questions I wanted to get to today. Uh, unless Dan or Camille, you see something that
Well,
you think is a
I'd
must.
say that, a lot of these questions are great questions and much deeper questions than we've gotten on other features. And I think it's uh, it's good because Monte Carlo is at the end of the day the result of the plan. So if you feel like your question wasn't answered, you want a deeper answer on that, you can absolutely book an expert support session. Camille is going to plug the expert support session into our chat. If you don't see the chat at the bottom of your screen in the center in the navigation menu, there should be a button that says chat. If you don't see it, try clicking on the more button. You can also save the chat by clicking the three dots next to the smiley face icon. That way, information we plugged in there, blog posts, expert support session link is accessible to you later. But what I would do is click on that link, just bookmark it. If you're logged into your into WealthTrace in your profile, there's a book expert support session link. Clearly, you have questions. We want to answer them, and we don't want to answer it with it depends. We want to answer it by looking at your plan directly and answering it for you.
Yes, thanks, Dan. And let me just summarize just real quickly what we went through today. I really want to do to, get through the value of Monte Carlo analysis. It really is such a powerful, important number. Uh, and also, this addition of guardrails adds more realism to the results. So, guardrails combined with Monte Carlo is just it's a great tool to have. I really recommend trying out the guardrails. Sequence of returns risk is related to this, related to guardrails. Applying guardrails to your plan can reduce sequence of returns risk, sometimes by a lot. And as I mentioned, it's most impactful if you have to spend down your investment principal. So, if you have questions, as Dan said, you can email us, you can use live chat. I am available for expert help. This would be an expert support session. You can see the link here. Like I said, Camille's going to send that out too. And this support session would be with me. It would be one-on-one. We would go through your plan. I can help you navigate the Monte Carlo screen, go through your settings with you, make sure it was all entered correctly, and run any scenarios you want to run.
I just want to
And
point out after the webinar, in the next 24 hours, you'll get an email with a recording if you want to watch this again. And we're also, if you are an existing user of WealthTrace, uh, we need to grow. I joined WealthTrace because I believe in WealthTrace. I just joined in January. I'm a practitioner, and I think that WealthTrace uh, has the engine to take it beyond a lot of advisor tools. And I want to make that happen and make that real. And the only way that happens is if we grow our base. So we will send the recording. We will ask for referrals. If you know of people that would get value of using this tool, please forward forward wealthtrace.com to them. Have them sign up for a trial to check it out.
yeah, okay, great. Thanks, Dan. And thanks everybody for joining. That's all I have today, and we'll see you at the next webinar.